Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Thursday, April 30th, and you are tuned into Next Level Charting. Thanks very much for joining us. So today I want to put this bounce into perspective. It is one heck of a bounce. SPY is nearing its 200-day moving average, the S&P 500. Small caps are leading with pennant breakouts. Several industry groups associated with small caps ETFs are also playing catch up with pennant breakouts. And then I want to review the weekly charts for the 5 offensive sectors: technology, finance, industrials, consumer discretionary, and communication services. So the short-term uptrend is extending again this week, and it looks like the siren song of the 200-day moving average is coming into play, and the S&P 500 SPDR is gravitating towards that falling 200-day moving average. I still think it's important that we keep this bigger picture in mind, in the fact that we had this huge decline and we've got a huge rally, but it still hasn't broken above the 200-day, and the 200-day is still falling. So as strong as this advance seems, it is still looking like a counter trend advance. Now, towards the end of the month and beginning of the following month, you usually get some inflows coming in, and that could be pushing the market higher. We've also got a Fed meeting this week, and that could be buoying the market, as well as fiscal stimulus, blah, blah, blah. But that's all the fundamental stuff. But still, from a technical standpoint, you have a breakdown and you have a counter trend advance. And the breadth models that I use have not turned bullish yet. It takes more than a counter trend bounce to turn the breadth models bullish. So if I look at this, I still think we're in a danger zone here. We hit this danger zone. Well, we hit the caution zone, then we got to the danger zone, and now we're pushing up very close to, at 200 days, right at 300. So we're right around 292, and you can see support here in that 270 area. So that's the first level to watch to see for some sort of a breakdown. But as long as the short-term uptrend remains, we could get to that 200-day. Now, we really saw a surge in small caps and mid caps and, say, the average weight stock in the S&P 500. So this is RSP. It's the equal weight S&P 500 ETF. There you can see the symbol there. So whereas the S&P 500 is treating the large caps more favorable, in other words, it's much more weighted towards the big stocks, this equal weight S&P 500 ETF tells us what's happening with the average stock in the index. And I pointed out this pattern at Trend Investor Pro last week, and you had the big surge and what looked like a flag, a bull flag, and then you can see we got the breakout and follow through. And this is a short-term bullish configuration, surge, consolidate, breakout. But if you look at the longer-term picture, you still have this big breakdown and this huge counter trend bounce, and you're below the falling 200-day moving average. So again, it's a short-term uptrend, it's a short-term breakout, but you're coming into that 61.8% retracement area, and you're still below the falling 200-day. So longer term, the picture is still negative. If we look at mid caps, we can see a pennant was forming. There we have the contracting trend line. So basically you have a surge, and then you have a contraction there, a consolidation, and then the breakout. And again, we're well below the falling 200-day, and we're coming into that 50 to 62% retracement zone, which is a danger zone. And then if we look at IJR, there is a pennant as well and a breakout, and moving towards the upper line of that channel. I wouldn't call that really resistance. I use those lines kind of identify the pattern at work. But IWM was the one that first started it off, because you can see IWM here, and this pattern was pointed out at Trend Investor Pro. We had this surge and this pennant, and we got the pennant breakout, and then look at that follow through on Monday, Tuesday, and Wednesday. But again, I still call it a bear market bounce. We're below the falling 200-day moving average, and we're just now entering that 50 to 62% retracement zone. So as powerful as this advance looks, it's still in the realm of a bear market rally. So we're also seeing these lagging sectors play catch up. Last week, I talked about the equal weight finance, consumer discretionary, and industrial sectors were lagging. And today I'm going to show you two of them that are perking up today over the last 3 days with a big bounce. Because if you look at finance, it was down and it had yet to bounce. It was still in the midst of a short-term uptrend and was finding support there around 21 and then got this lift off here off support. But in the bigger scheme of things, it is still lagging. It's well below the 200-day. But with this breakout, maybe it gets to the 50 to 62% retracement zone here. And then if you look at the industrials SPDR, it was also forming a pennant formation there. So there you can see the surge and the consolidation with the pennant and then the breakout. And so that target zone would be somewhere in that 66, 68 area, which it's nearing right now. So if we look within the industry group ETFs, we're also seeing a lot of groups that were lagging a bit, playing some catch up with big moves over the last 3 to 5 days. Here is iPay. And, it was dilly-dallying around that 38% retracement when some of the other tech ETFs were already near their 61.8% retracements. But iPay did form a bullish pennant and got the breakout actually on Friday. Tried to on Thursday, but fell back and then broke out on Friday. And there you can see Monday, Tuesday, and Wednesday so far. But again, it's still below the falling 200-day and entering that 50 to 62% retracement zone. Housing is one of these groups that I would associate with small caps, mid caps, the domestic economic situation. And if we look at this chart here, and I'll go ahead and do a live annotation here, we can see that it's making a big surge the last 5 days. It fell back to support, firmed, and then got this big lift off. But, overall, it's still below that falling 200-day, and it's entering that 50 to 62% retracement. So, if you're going to pick a bottom, pick it near the bottom. I think this is a pretty precarious spot that we're entering right now and would prefer to be neutral as we head towards this 50 to 62% retracement zone, and we are below a falling 200-day moving average. Here is XHB, the Homebuilders Etf, and there it as well is getting a bounce off support heading into that 50 to 61.8% retracement and below the falling 200-day. And then just below, we've got retail. And retail had a big surge, a tight consolidation, and it got a breakout on Friday and then surged the last 3 days into that retracement zone. But still, it's below the falling 200-day moving average. We look at banks. It was one of the weakest. It was dilly-dallying around here near the lows, but caught fire over the last 4 days with a big bounce. And regional banks, this is one I would also associate with small caps. If you look at the small cap holdings, the financial services sector is the second largest sector in that ETF IWM. And we can see, it was underperforming here in that 33 area, but got a big surge the last 4 days, but still well below the falling 200-day moving average, and it's just now got above the 38% retracement. So overall, it's still a laggard. So let's look at some of the sector SPDRs, see where they stand on the weekly charts. I've got 4 indicators here. The red line is the 40-week moving average. I've got the Fibonacci retracements tool marking the retracement of this big decline. I've got RSI, 14-week RSI, and I've got Arun. So let's first look on the chart. So we are back above the 40-week moving average, and this retracement has been very strong because it exceeded the 61.8% level. So this has been one of the strongest bounces that we've had, and maybe you could consider XLK in an uptrend. But if we look at the indicator windows, we can see that RSI, the bull range, is from 40 to 80. And you get into this bull range when you get above 60. So you get above 60, that's bullish, and it stays bullish until you get below 40, broken out of your bull range here. You can see here's when we broke in, it's in November when we broke into a bear range, and then we got back into a bull range in March. This is a trend following type of signal here. So it's not going to call the bottom. It's going to be late, and there can be whipsaws. But right now, you can see it moved into bearish mode in March there, early mid-March, and it is yet to move above 60. It needs to get up above 60 to put RSI in bull mode. And then a rune down surged to 100, which means you hit a 13-week low. And that's obviously bearish. And you can see that's a rune up, and it hits a 13-week high when it gets to 100. That signals a 13-week high. And until we get a move up in a rune up and a 13-week high, this indicator remains in bearish configuration. So both of these indicators, I think, are still in bearish configurations. Now the next is XLY, and you can see that it had a big breakdown and a big advance led by Amazon. It's above the 61.8% retracement and just below the 40-week moving average, which is turned down. So yeah, it's not really in a bullish configuration there. And you can see RSI broke into bear mode there at the end of February below 40, and it is yet to break above 60. And a rune down hit 100 at the end of February. So it's in a bearish configuration. And this is a longer-term trend indicator. Now we look at finance, XLF. It broke down as well. It's well below the falling 40-week. It has yet to exceed the 50% retracement. You can see RSI turned bearish there at the end of February, and it remains in a bearish configuration. The same for Arun. Arun down hit 100, and we have yet to see an upturn in Arun up. So a bearish configuration all around, which makes this a counter trend bounce. We look at XLI on this weekly chart. You broke down with RSI breaking below 40 in February, and it's in a bearish configuration until it breaks above 60. And then you have Arun hitting 100 at the end of February. So it's still in a bearish configuration. Here is XLC, and again, there's RSI breaking below 40, and it remains below 60. Arun down hitting 100. So this is a bearish configuration, and you're below the 40-week moving average, and you're right at the 61.8% retracement. So yeah, this is a big bounce, but it's still a bearish configuration. So that concludes this edition of Next Level Charting. If you'd like to learn more about my website, please visit trendinvestorpro.com. Thanks very much for tuning in, and have a great day.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.